Good morning. This is Professor Marsh again, and we are moving now into Chapter 4, the adjustment process in Principles of Financial Accounting. That's Accounting 210-0 in the spring of 2022 at Newberry College. So welcome back. This morning what we're going to do is talk about the first part, the first two sections of Chapter 4. And Chapter 4 now brings us into steps 5, 6, and 7 of the accounting cycle. And so we're going to, the period has now ended, and we have an unadjusted trial balance, and we're going to make the adjusting entries that are necessary to get us to the adjusted trial balance. And so, during this chapter, this unit in the text, you're going to return to seeing some examples that involve Mark Summers and his dry cleaning business, and Printing Plus, the print shop, and some of the typical entries that we're going to find for either a service or a merchandising business in accounting. And again, we're learning accrual accounting, and so we're going to make some entries that attempt to match revenues with expenses and to record them in the correct period. So that's basically what we're talking about. So these are end of period adjustments that answer the question, what do we need to do as far as the end of the period adjustments to accurately reflect the income for the period. And that's takes into account things like equipment and supplies that were used during the period that were purchased and were set up as assets, but since they were used, they are now less valuable, either because the supplies were used or because the equipment has depreciated. And we're going to get our first introduction into the concept of depreciation that we will cover in much more detail in the future. Or perhaps we owed money to employees for work that was performed during the period, but payroll hasn't yet processed, so there hasn't been a cash transaction to pay these employees. But like most employees, they're paid in arrears, and sometimes that will straddle the end of a period. Or we have a savings account or other bank account that earns interest, or perhaps a note receivable on which we need to accrue interest that has not yet been credited. When we get to Chapter 8 in the materials, we're going to get into handling the cash accounts for the business in much more detail, and how to do a bank reconciliation and things of that nature, so you can look forward to that. But for now, we're just going to make some simple entries to accrue the interest on cash assets or other assets that earn interest. And we'll also look at what to do for customers who've paid in advance. So sometimes you get a deposit from a customer, or sometimes you have a customer who enters into some sort of long-term relationship, perhaps to get a discount, and they give you some cash up front for services that are yet to be performed. And so we'll look at how to do the accounting for that. So let's move on and look at the chapter Learning Objectives. And so we've got 5 learning objectives. We're going to talk primarily about the first 2 in this lecture, but we're going to explain the concepts and the guidelines affecting adjusting entries. What are the guidelines? Which entries can we make? Which entries do we not make in order to follow the principles and assumptions and concepts that we have for accounting generally under GAAP. Then we're going to discuss the adjustment process, and we'll illustrate common types of adjusting entries. And then in the next lecture, we're going to look at how to record and post common types of adjusting entries, and then how to use those adjusted ledger balances to prepare an adjusted trial balance, and then look at how the financial statements are prepared using the adjusted trial balance. Now, for the 5th learning objective, we're going to go back and probably handle this in more detail when we get to Unit 6. So for right now, we'll sort of skim 4.5 as far as preparing the financial statements. But in the meantime, let's look at Section 4.1, the first section in this unit, which is to explain the concepts and guidelines affecting adjusting entries. And so without much further ado, let's look at, if you look at in your book at figure 4.2, you'll see the 10 steps in the accounting cycle, and you'll see from the shading that we have now moved on to steps 5, the adjusting entries, step 6, prepare the adjusted trial balance, and step 7, prepare financial statements from the adjusted trial balance, but prior to the closing entries. So we're about halfway around the circle, and that's also reflected in figure 4.3 as well. So these next 3 steps are going to show us how to prepare these typical adjusting entries, and then we're going to consider their end of period transactions and their impact on the financial statements. So accrual basis accounting is used by both U.S. GAAP and also the International Financial Reporting Standards govern companies. So basically by all the accounting that's done for companies that are doing accrual basis accounting, that are reporting financial statements to the public and to companies that are getting audited financial statements, that sort of thing. So accrual basis accounting is used by U.S. GAAP and the IFRS governed companies. It requires revenues and expenses to be recorded in the accounting period in which they occur, not necessarily where there's an associated cash event happening. So in cash basis accounting, which is what most small businesses, certainly most small service businesses like my law firm, other small businesses that use cash basis accounting for taxes and for financial statements, you have to wait for a cash transaction. But in accrual basis accounting, you really try to analyze the transactions as they occur and properly record them as the economic events occur that affect revenue and then also the associated expenses. So for example, you have a 50% deposit for catering services to be performed next period. When that 50% deposit is received, then that it's a cash transaction, but it is not revenue at that time. So that needs to be set up as a liability. It's unearned income, and so the cash is recorded as an asset, but then there's an offsetting liability entry for accrued income, which is a short-term liability. So companies need timely and consistent financial information presented for users to consider in their decision making. If it was just cash-based, then you would have a mismatch of perhaps overstating income in periods in which collections were good and understating income in periods in which collections of cash were slow. And it doesn't necessarily reflect the actual income of the business. And accounting periods help companies have that timely and consistent financial information. It breaks down information into months, quarters, half years, and full years. And as we're going to learn in just a few minutes, less than a full year is typically called an interim period, but we'll get back to that. So the next section, the accounting period, talks about both calendar years and also fiscal years. So a calendar year is a year that begins on January 1st and ends on December 31st, just like the calendar. A fiscal year is any 12-month reporting period that doesn't begin on January 1st and end on December 31st, or really any 12-month reporting cycle that ends on a month other than December. Fiscal years typically do not occur in the middle of a month. Typically, any year, obviously a calendar year always ends on December 31st. A fiscal year will end at the end of a month other than December. So it'll be a 12-month period, perhaps beginning on February 1st and ending on January 31st, which for many types of businesses, particularly ones that are seasonal, oftentimes they'll have a fiscal year so that they get the Christmas sales in December, but then also get the sale, the post-Christmas sales that typically occur in January or sometimes even into February. So oftentimes a company will not have consistent sales during the year. They'll be seasonal, particularly for a lot of retailers that do holiday sales, and they oftentimes will have a fiscal year. Okay, and then the concept of an interim period. An interim period is any reporting period that doesn't cover a full year. And that can be useful when you need timely information for users that are making financial decisions. You can't wait till the end of the year. You need to see how the business is doing this past quarter or this past month, depending on what's going on with the business. Now, do note at the end of section 4.1 that there is a ethical consideration: illegal cookie jar accounting used to manage earnings. And the example involves Bristol-Myers Squibb, and they received a $150 million fine for the manipulation of their earnings that they did about 20 years ago, where they created a false indication of income and growth to meet certain targets. There are analysts on Wall Street who follow large public companies like Bristol-Myers Squibb, which of course is a large pharma company, and what they were doing is they were getting to the end of a period and they were pushing product down to their wholesalers ahead of when the wholesalers actually wanted to receive that inventory, and they were recognizing revenue based on the average profitability of that inventory, as those were real sales, even though they were guaranteeing the wholesalers a profit. And so Bristol-Myers had not really given up the economic risk that those sales would in fact occur. They just wanted to show an increase of sales and an increase in profitability to meet the analyst's expectation to keep their stock price high, so that they could use their stock perhaps to purchase subsidiaries or to keep good credit with their lenders. And this illegal manipulation led to a very significant fine of $150 million for doing that. So that was a very bad thing that Bristol-Myers was doing. Those weren't real sales. They did ship the product to the wholesalers, and perhaps most of those were eventually sold, but Bristol-Myers hadn't given up the risk. It wasn't a real sale. They hadn't really transferred the risk of ownership to their wholesalers, and that practice was wrong. Now, I know in practice that I represented a very successful business that was sold to a public company, and what my client continued to work for the company after she had sold the stock to this successful public company. And what she found is that this company had a practice of capitalizing a lot of employees' salaries and other operating expenses, which probably should have been expensed, in an asset called restructuring costs, that they would set up an account for restructuring costs, and then every few years what they would do is they would take an extraordinary charge to earnings for the accumulated restructuring costs that were in excess of what they then estimated their restructuring costs would be. Now this is a very sophisticated but also arguably unethical, well, probably definitely unethical, arguably illegal accounting practice, in which they weren't accurately reflecting their period expenses. They were very inefficient in the way that they did things compared to how my client had done things when she had owned the business herself. And what would happen is that the analysts would ignore the restructuring costs as an extraordinary event and just look at core earnings. Well, the core earnings were probably higher, but every 3 or 4 years the company would have this extraordinary event and write off all these fake assets because they really weren't, the restructuring costs were not, producing a real asset that had some future value. It was just a way of hiding excessive spending for a lot of people who weren't productive. So in any event, just watch out for that. There's a number of techniques that large public companies do to try to manage their earnings, and many of them are definitely unethical, and some of them are actually illegal under the securities laws or under the requirement to have accurate books and records under GAAP. So let's move on to section 4.2 and just spend a little time on that. This is a large section, and what this does is it gives you not only the theory. 4.1 was sort of the theory of adjustments, and 4.2 gives you an example of lots and lots of types of adjusting entries, really the most common adjusting entries. And so as you do your homework, you're going to be able to find examples of the adjustments that need to be made for the different types of adjustments that we do in order to convert just the cash transactions into proper accrual. So one type of adjusting entry is a correcting entry. You have an incorrect balance on the unadjusted trial balance, and that can occur because not every transaction produces an original source document that will alert your bookkeeper that it's time to make an entry. It's not that the accountant necessarily made an error, it's just an adjustment that's required to correct the balance. Regarding need for adjustments, some account adjustments are needed to update records that may not have original source documents, or those that do not reflect change on a daily basis. The revenue recognition principle, the expense recognition principle, and the time period assumption all further the need for adjusting entries because they require revenue and expense recording to occur when earned and incurred in the current period. So that's an example of or just perhaps a little bit of the theory behind the rationale behind adjusting entries. And so the large categories, the main categories of adjusting entries are prepaid expenses. So you've prepaid for expenses for things that you're going to not use currently, or that haven't been used through the end of the period that you're looking at. But they have to be set up as assets, and then during the period as they're used, the expense is recognized based on what percentage of that asset is used. So examples of this can include supplies. Obviously, you purchase a lot of supplies. You go to the Office Max or Office Depot or the other supplies retailers, and you purchase supplies, and maybe if you're a law firm, you buy 10 legal pads, and during the period you use 3 of them. And so you've set up the 10 legal pads as a supply asset, and you've used 3, so You take 30% of the cost and treat that as an expense during the period because you've used 30% of those supplies. Or insurance. You always have to pay for insurance in advance. And so perhaps you pay a 6-month premium. If you were doing the expense for the period, then you would have to take 1/6 of that for 1 month if it's a monthly period and write that off as an expense. Depreciation. You purchased an item of equipment that you expect to last for 5 years, and perhaps it cost you $5,000. And if you're using straight line depreciation, for the first year you'd write off $1,000. Or if it was 1 month of the year, then you'd write off 1/12 of the $1,000 for the year, which would be about $83.33 as the monthly expense for depreciation. Rent is typically paid in advance. So if you paid a year's rent in advance for an asset and you were doing the accounting for the month, you would take 1/12 and treat that as an expense and then reduce the asset. So you would convert an asset into an expense, and that is a credit entry to the asset. Remember, they're typically debits, and it would be a debit entry to the expense for depreciation. So that's one type. So prepaid expenses, one major category of adjusting entries. The second category, major category of adjusting entries, are unearned revenues. And so unearned revenues, these could be customer advance payments for products or services yet to be provided. So remember the example I gave you before of the catering business that takes a 50% deposit for an event that's going to occur in the next period. So you've received the cash. You set that up as a liability. The debit entry goes to cash because you're receiving cash from a customer, but it's not yet revenue. The credit entry goes to unearned revenue. It's a liability, and then when you get into the next period and you have the event, you get the other 50%. Then at that point, you recognize the revenue for the entire period, and you only get 50% of the cash because you already have the other half of the cash, and so your debit entry is to eliminate the unearned revenue liability. So that's another way that you try to match the income and expenses with the proper period. Accrued revenues. So the third category, accrued revenues. These are revenues earned in a period that have yet to be recorded and no money's been collected. Accrued revenues updated at the end of the period to recognize revenue and money owed to the company. And a simple example of that could be interest earned on a bank account or interest accrued on a note receivable, and those will have a lot of reason to come back to those types of specific techniques for handling bank accounts when we get to bank reconciliations in Chapter 8, and we'll also look at handling short-term and long-term assets and those sorts of things, notes receivable, accounts receivable. So prepaid expenses, unearned revenue, accrued revenue, and also, guess what, accrued expenses. So accrued expenses are incurred in a period, but they're yet to be recorded and no money has been paid. A good example of that is the payroll example, where the workers have done the work, but perhaps they don't get paid on the 31st, they get paid on the 5th of the following month. And so at the end of the period that ends on the 31st, you have to set up an expense and an offsetting liability for accrued payroll expense. typically workers get paid in arrears. Landlords get paid in advance, workers get paid in arrears. It doesn't seem fair, does it? And what you see at the end of this section is, once you get past figure 4.4 is the unadjusted trial balance for printing plus, and then they take you through a whole long example of just how to make the various adjusting entries for the various the various types of adjustments that need to be made. So the first example shows you how to journal the supplies account. So when you purchase the supplies, you get you pay $400 for supplies. This is like my example of legal pads before, but you can actually see the journal entry here in front of you. So you purchase the supplies, you debit supplies, which is an asset, so you credit cash because you're reducing cash to purchase that asset. Remember, cash is another asset, but so you're trading one asset for another asset. You have a debit entry and a credit entry. Debit entry increases the supplies asset. The credit entry shows that you spent the cash. And then you get to the end of the month. So the first entry is not the adjusting entry. The adjusting entry is the second entry. So you get to the end of the month and you realize, hey, we've used $150 of these supplies. And so what you do is you create an entry that recognizes that. So you hit the expense account with a debit of $150. Expenses, the normal balance of expenses, is a debit. And then you credit the supplies account, which is a reduction in the supplies account, because remember, supplies are an asset. So you reduce them with a credit entry to show that you've used $150 of your supplies that you had set up as an asset. So the adjusting entries, no cash have changed hands at this point. You just are setting up that expense to show that you used 150 of the $400 in supplies during this particular period. So that's the idea. And then they show you the T accounts, and you can see how that works as well in the example. And then there's an example in teeny tiny print of depreciation on the equipment, and this is like the example I gave you earlier, except the numbers are maybe just a little different. You've got a $2,000 piece of equipment that you bought at some point in the past. They don't give you the entry to set up that asset, but they do say if it's 4 years, and if we're looking at the first year depreciation expense, then you take 1/4 of the 2,000, and you would take a $500 expense deduction, and then credit the equipment. And it's a little bit different for depreciation than it is for supplies. So with supplies, we just reduce the supply asset. Depreciation works a little bit differently because you set up what's called a contra account to the asset account. So on the asset side of the balance sheet, you're going to see the first entry for equipment, and that'll be typically have a debit entry because it's an asset. But then there's a contra account under equipment because we want to see how much of that equipment, how old that equipment is, how much has been used up in terms of its useful life. And that contra account is accumulated depreciation, and that's typically a credit balance. In fact, that's always a credit balance. So in any event, when you see the presentation on the financial statement, you'll see how it works. But they do have an example here in the book on how to do the entry for depreciation. We're going to get much more into that in a later chapter in the book. We're going to look at handling long-term assets. I think that's back in chapter 11 in the book. But in any event, this is your first little taste of it at this point. Then there are examples for prepaid insurance. Insurance like rent is typically paid in advance, and you take this is just an example of straight line treatment of all these expenses. So when you pay the insurance premium, you have an asset for the life of the policy, and as the policy, expires, month by month, you take that proportion of it and you write it off as an expense, or period by period. So rent, same thing. And you can see all the journal entries and all the T accounts for these particular types of adjusting entries. Accrued revenues, they have interest receivable and interest revenue. So that's set up to record the interest that accrues on a note that hasn't been paid during the period. You've got service revenue and accounts receivable for work you've done, services that you've done for a customer, but this customer hasn't paid yet. Very common in the legal business to have accounts receivable. Although most law firms run on a cash basis, and most small businesses, our main financial statements are our tax returns. Our tax returns are always almost always on a cash basis, not always, but probably 90 to 95% of the small businesses in America are run on a cash basis and use cash basis accounting, but this is the accrual basis. So you're learning a special type of accounting that would prepare you to work, for a larger company that does accrual accounting under GAAP. Then you've got accrued expenses, interest payable. If you've got a period that straddles the deadline for repayment of a note, due date for repayment of a note, you would book the interest expense for that period based on the proportion of the interest that accrued during that period of time. And then taxes payable. Taxes oftentimes have to be estimated and booked based on what you expect to have to pay in taxes at the end of the year, which for corporations, the due date for corporate taxes is March 15th of the following year, or if it's on a fiscal year, then 2.5 months after the close of the fiscal year. And for individuals, as you all know, it's April 15th. So sometimes you will accrue some taxes, particularly if you're profitable. And then when you get to the adjusting entries and they have your turn, Table 4.1 gives you an example of 3 adjusting entries, and then if you would like to do so, it would probably help you in the homework to go ahead and take a shot at doing tables 4.3 and 4.4 and seeing how that works for yourself. So anyhow, there's note there's an example of Elliot Simmons, who has a small law firm, and they show you how to do supplies inventory adjustments and also interest that's earned on a bank account. Look at the example of the supplies account journal entries, 400 to purchase, the adjusting entry for 150 for supplies, and then you've just got all these examples of all the different types of entries that you're going to see in your homework. So at this point, I've probably gone on long enough about the first 2 sections in Chapter 4. Go ahead and get into the chapter, read it carefully. If you want to start doing some of the exercises, go right ahead. I'm going to be posting the homework and the quiz for Chapter 4. But do understand that at this point, today is February 22nd, which is Washington's birthday, and George Washington's birthday. It is also the deadline for catching up in this course. So at I think midnight tonight, or maybe 5 minutes before midnight, I have extended the deadlines for those of you who got into the course a little late. I've extended those deadlines for you to submit homework and quizzes for sections, chapters, units 2 and 3. So make sure that you're caught up with Chapter 2 and Chapter 3. The administration at the school has been contacting those of us who are teachers and telling us that we need to make sure that work is being timely completed, and that's so important for this particular course. It's if you don't really study chapters 1 through 5, if you don't get that, the rest of the course isn't going to make any sense, and you won't be able just to jump in in November and catch up. So this is really important stuff. A lot of you are not watching the lectures. I can tell that because I get a count from YouTube as to how many views there are. There are 22 of you in the course, and I think the highest number on any of my lectures is about 17. So I know a few of you have never seen even one lecture, and the numbers are lower for some of the others, 11 or 12 for some of them, and I think maybe my wife has watched a couple, so she's not even in the course. So please look at all the lectures, do all the homework, submit it all. We did pretty well for Chapter 1. A few of you have dropped off for Chapter 2, and I need you to get that done by tonight, so I can go ahead and record the lectures. When if you haven't looked at it yet, I did a review lecture for the quiz for Chapter 1 for Unit 1, and I'm going to do a review lecture for the homework and the quiz for Chapters 2 and 3. So please get busy and watch the lectures, do the homework, stay current with the quizzes, stay current with your reading, and this course will be a lot easier for you than it otherwise would be. So have a great day, and we'll talk again soon. Thanks a lot. Bye-bye.